Good day, ladies and gentlemen. My name's Lukwago Edward. I'll be taking you for taxation management and planning. Now, before we look at the details of taxation, we need to know to define what taxation is. Tax can be defined as a monetary charge imposed by government on persons, entities, transactions, or property to yield public revenue. Where payment is not monetary, a more wide-embracing definition has been adopted as taxes are the enforced proportional contributions from persons and property levied by the state by the virtue of its sovereignty for the support of government and for all the public needs. One of the main characteristics of a tax is that the payer does not demand something equivalent in return from the government for the payee need. So that's what we are seeing from our definition of the taxation, where a taxpayer makes a contribution to the government but does not expect to receive an equivalent return from the government. So that's our simple definition of taxation. Now, before any government can impose tax, there must be laws put in place which enable it to impose taxes on its citizens and residents. There are many laws which have been passed, and these laws enable the government of Uganda to levy taxes or to impose taxes. For us, in our studies, we shall look at a few of them. One of them is the Income Tax Act, Chapter 340, the Value Added Tax Act, Chapter 349, and then the East African Community Management Act. Those are some of the laws which have been put in place to enable the government of Uganda to impose taxes on the residents of Uganda for tax purposes. Now, having looked at the legislation, the legislative part, now we have to look at some of the principles or canons of taxation. Principles or canons of taxation. Now, these canons or principles were first formulated by a certain gentleman called Adam Smith, and he looked at the basic four canons of taxation. So we can look at what they are. Principles of taxation are concepts that provide guidelines towards a good tax system. So they provide the guidelines towards putting in place a good taxation system. So the first four principles or canons were formulated by Adam Smith, and these are equity, economy, certainty, and convenience. So we are going to look at the first one. So we are looking at the canons or principles of taxation. And the first one, we have said equity, then we have said certainty, then we have said the economy, and then we said convenience. And others. So let us first look at the equity or fairness. All fairness. So these are Adam Smith's canons of taxation. The first one is equity or fairness. Tax should be levied fairly so that the same amount is paid by persons or entities that are equal in earnings or wealth, what we call horizontal equity. Horizontal equity. That would be horizontal what? Equity. So we are saying here we can give an example. If shopkeeper B makes a profit of 10 million in a year and is taxed at 10%, then we have another trader who makes a profit of the same amount, 10 million. Both of them should be taxed at the same rate of 10%. Both of them are earning the same amount of profit. They are earning 10 million. B is earning 10 million as taxable profit, and C is also earning 10 million as taxable profit. Both of them should be taxed at the same rate. So if the rate is 10%, then it means each one of them will pay 1 million as tax. Then there's what we call vertical equity. Vertical equity. When we talk about vertical equity, what do we mean? We are looking at two persons or two entities, entities A and B. Entity A has taxable income of 100 million, and entity A has taxable profit of 100 million, and entity B has taxable profit of 200 million. Now, these do not have the same taxable profits, so they should be taxed at different rates. So the one of 100 million may be taxed at 10%, and then the other one of 200 million may be taxed at 15%, meaning each one should contribute proportionally to the revenue of the government in proportion to their incomes. So that is the equityness, where we have seen horizontal equity and we have also seen vertical equity. Then we look at certainty. So we are saying a good tax system is one where the taxes are well understood by the payers and the collectors. The collectors are in Uganda is Uganda Revenue Authority. The time and reason for payment, as well as the amount to be paid by the individuals or entities, should be well documented and certain or known. These taxes should be based on the laws which are passed by what? The Parliament. So the taxpayer should know what amount of tax is going to pay, when is he going to pay it, and where is going to pay that tax. And that tax must have been imposed by the laws of the country. Then we look at economy. Here we are comparing the cost of administrative cost of collecting the tax and the revenue generated by that tax. The cost of compliance to the taxpayer should be very low. The cost of collecting the tax should also be very what? Low. So if the taxpayer, in order to comply with that type of tax, has to incur a lot of costs, then that one is not an economical tax. Or if the tax administrator, for instance, Uganda Revenue Authority, incurs a lot of costs in order to collect the tax, it may not be economical. Simplicity would be another. So here we look at another one which we are calling convenience. We have convenience there. Here we are looking at a situation that from the point of the taxpayer, it should be easy for him to pay the tax. maybe where he's going to pay the tax should be very near him. The time when he's going to pay to him should be convenient, and then when he should be taxed should also be convenient. For instance, if you have farmers, this should be taxed when they have sold their what? Produce. Then we have other canons which expect you to read. You have to read those canons. Then we look at the role of taxes, the role of taxation, and these ones are also easy to read. This could be the functions or the roles. So here I'll just list them down. One of them is to finance government expenditure, meaning the taxes are used to generate government revenue. Then we can also use taxes to regulate demand and supply in the economy, especially in times of inflation. Then we can use the taxes to promote the growth of local industries by imposing high taxes on imported items so that the locally manufactured items are cheap. Then to protect the society from harmful or undesirable products, for instance cigarettes and alcohol, by imposing high taxes on them so that you discourage their consumption. Then to achieve greater equality in the distribution of wealth by taxing heavily the wealthy people of the society, so that that amount which you collect from them can be used to provide services to the poor in terms of medical health, education, and the like. So those could be some of the roles of why we should pay taxes. Why we should pay taxes. Now we want to look at the income tax. We want to look at the income tax. Look at the income tax. Now, when we are looking at the income tax, we have to look at a few things under the income tax. And when you look at the income tax, so this one talks about the imposition and collection of income tax. In Uganda is governed by the Income Tax Act, which was passed in 1997. Now this act is the one which we base on to impose tax on incomes. This tax is imposed on what? Income. So the income tax, this is a tax imposed on persons' taxable income at specific rates. A person includes an individual, a company, partnership, trustee, government, and subdivisions of government. So that's what we mean by the income tax. This is a tax imposed on a person's taxable income. Remember, this one, income tax, is imposed on the person's income. So the tax base is the income. So they are saying income tax is charged on every person who has chargeable income for each year of income. Chargeable income is derived from the three main types of income, namely business, employment, and property. So that will be our chargeable income. So we have these terms: gross income, then we have chargeable income. So what is gross income? Gross income for the year of income is the total amount of business income, employment income, and property income other than exempt income. So when we talk about gross income, what do we mean? We are looking at business income, we are looking at employment income, and we're also looking at property income. It does not include exempt income. Exempt income means that income which the law says will not be taxed. So, in case of resident persons, because we have already seen a person in tax means an individual, a company, partnership, trustee, government, and subdivisions of government. That is a person. So we are saying here, gross income, in case of a resident person, gross income is a person's income from all geographical regions. So from all geographical sources. So if you are a resident person, for tax purposes, here we are talking about a resident person for tax what? Purposes. We shall define what a resident person is. So the resident person's gross income includes all those incomes from all the geographical sources. Gross income from all geographical sources. So here we mean from Uganda and outside Uganda. That's what the sentence tried to tell us. That if, so long as you qualify as a resident person for tax purposes and you qualify as a resident person, all your incomes sourced in Uganda will be taxed, and all your incomes sourced outside Uganda will also be taxed in Uganda, so long as you are a resident person. How about a non-resident person? Non-resident person, his gross income includes only incomes sourced in Uganda, or derived from Uganda. So you can see a difference there. If you're non-resident, you can only, if you're non-resident for tax purposes, you can only be taxed on the incomes you have derived from sources in Uganda. But if you're a resident person, you will be taxed on the gross incomes you have derived from sources in Uganda and also from outside Uganda. Now we look at chargeable income. When we talk about chargeable income, it just means gross income less allowable deductions. Less total allowable deductions. So we shall remain with what we are calling chargeable income. That is the income on which we are going to apply the tax rates. So chargeable income is the gross income of a person for the year of income, loss, total deductions. So that's what we have in short. It is gross income less total allowable deductions. Why are we saying allowable deductions? Those deductions which are allowed under the Income Tax Act. These deductions, what you may call in your accounts expenses, some of the expenses which are allowed in computation of accounting profit may not be allowed when you are computing taxable profits. And then when you are computing certain taxable profit, when you are computing taxable profits, there are some deductions which you don't find in your profit and loss, accounting profit and loss, but we find them allowable when we are computing taxable profits. Now, residency. Having seen that to tax people in Uganda, or to tax incomes derived in Uganda, we need first of all to establish your status, whether you're a resident person or a non-resident person. So we look at the residency now. We're going to look at residency. Look at residency. So we first by looking at a resident individual. A resident individual for tax purposes. So here they are saying a resident individual, you will be a resident individual if A, you have a permanent home in Uganda. Permanent home in Uganda. If you have a permanent home in Uganda, then automatically you are a resident. Or B, you can say present in Uganda, is present in Uganda. You are present in Uganda for periods, for a period of 183 days or more, in any 12 month. In any 12-month period, in any 12 months that commences or ends during the year of income. During the year of income. During the year of income. So you are present in Uganda for periods of 183 days or more in any 12-month period that begins or ends during the year of income. The year of income in Uganda commences on 1st July in any year and ends on 30th June the following year. So that is our year of income. So if you have been in Uganda, you may not be having a permanent home in Uganda, but you came in Uganda for a period of 183 days or more for a period of 12 months, which could be at the beginning of the in the year of income, or we can call it the fiscal year, or towards the end. So whichever way. Alternatively, Roman 2, it could be you are present in Uganda, present in Uganda for periods. Averaging 122 days. 122 days in each year of income. Each year of income. In each year of income. So we are saying there is some words which we have omitted out. So here actually what they are saying in this Roman number 2 is that during the year of income, during the year of income,